Hello, everyone. Welcome back to the RationalInvestor.co's day. What is this? This is your School for Trader Development. I almost got caught up in my. It's funny how your brain sort of goes that way. You head down a line, and you're like, "Oh, wait a minute. That's not the daily brief. I gotta change my tune." Anyway, welcome back to class, everybody. Nice to see that at least we're recording on YouTube. So welcome back. As always, Brian, this is, and actually we've done this a little bit differently this term, haven't we? We've been meeting every second week. And what do you guys think about meeting every 2 weeks? You find the pace is a little too slow? Is it gives you enough time to digest everything? Oh yeah, you guys like it? Okay. Yeah, well, and if anything, try understand, you guys as sort of level 3ers, you're my sort of and I love the fact that some of you are slowly joining the TA pools and stuff like that. I mean, you guys are my you're welcome to come back to the school in any class, and if you want to do the whole options module next term to refresh yourself, just let me know, and you're welcome to come back. But the point is, yeah, we have been going a little bit slower this term, and I hope you guys have been enjoying the pace of the teaching. We are slowly working our way through, indeed, coming up on the sort of the latter third of the program. And actually, it's interesting. Even some of the level 2ers, they're chomping at the bit to get to work on the stuff that you guys had at the beginning of the program. Has anybody actually been setting up like day trader checklists and stuff like that to try and help them stay focused and what they have to do on a daily basis? I hope so. These things are a life checklist. That's not a bad idea, Kevin. I could probably use that. I hope you've been enjoying working with different ways to manage stops, although we really haven't been having a strongly trending market to work with in particular. But, it's interesting to watch, like Grim on the Daily Brief, for example, managing his stop on his bought crude oil trade. Really good working models. I hope you guys have been, watching and trying to use stop management techniques, the 3 high-low method, stuff like that. I gotta say, you level 3ers really embraced harmonics earlier in the year, and I was even I got a message from I think it was Warwick. I'm surprised I don't have it on here. And he had been watching a particular harmonic pattern on crude oil recently, and like the market just nailed it and then just totally collapsed. It was quite alarming. and it often is when you see these harmonics, when sometimes the way price can violently swing off of them. And once you've seen one and you've gone through the whole process, I'm trying to find him on here, but I don't see him on. There's Raf. Where are these slackers? Both of these guys, they're not here in class today. Anyway, but here was Warwick's harmonic. You've been watching it, and the market just went into free fall on this event. It's textbook, absolutely textbook. And the cool part about it with Warwick is he's been following this thing along and watching the way the price just melted down here on Friday. I'm sure it just gave him immense mental capital going forward. So hats off to all you guys, and especially that group, Raf, Warwick, I was mentioning before we started recording, Keith, Wayne to a certain degree. Those guys really have gelled nicely, and I love to see that. Because, the interesting thing is you might actually build like friendships that you're going to have for the rest of your lives here. Is it in a weird sort of way? You guys are like a fraternal class. And and it's interesting. I even, just talking to the level 2ers, they can start to feel it now. What do you think? Is it, guys, is it easy to converse with the public about the market now and Bitcoin and, when to buy altcoins and stuff like that? Do you find it's a little difficult to interact with the public at cocktail parties and stuff now? I know some of them are going through that process of sort of, yeah, I can't do it anymore now. Yeah, you too. You speak the same language, eh? So at least you got your brother, so that's pretty lucky. Mark. The point of the matter here is we've been giving you some really great stuff to work with. As I had said, some of the options material, the group of you guys, Raph and Warwick and Keith and Wayne and et cetera, and Bobo. Where is Bobo? I haven't seen Bobo on the site at all lately. I hope he's doing okay. They really wrapped their arms around this options material, and it's just fantastic to watch. And Raf is becoming just a shark at finding these ideas now. So very, very impressed with the hard work that they put in, and I think they have a skill basically for the rest of their lives. And I hope all of you can do the same. It's incredibly, once you understand the derivatives markets and the way that it's built and how people use it to their advantage. It's stunning. And actually that's great seeing them. They're off trading coffee and cocoa and yeah, you name it, all over the place. I was mentioning earlier, one of the level oneers found a really good stock, PepsiCo. And as I said, Raf went and found just the perfect option, just absolutely perfect trade. I was just so impressed. We spent last session together introducing you to seasonality, and also too, when I was working with the group tutorials, and I hope everybody had an opportunity to watch them because they were really good sessions. I saw that they were applying a seasonality, and I was talking about coffee there a moment ago. I think coffee is supposed to be coming into a seasonal window. And it's interesting, you look at the price chart, and it's beautiful, right? It just corresponds so nicely. So it's great to see that they are starting to apply that seasonality thinking in the market. And keep in mind, all different markets have different seasonalities. If you are just strictly crypto oriented, then, lucky for you. After a really shitty winter, I think the altcoin market is actually heading into a seasonally friendly period over the next few months. So maybe we will finally have a little bit of a reprieve from this pullback in crypto space. But nonetheless, that's obviously a function of Bitcoin as well. But I hope you're finding that the treating seasonality information is of benefit too. And it also too, hopefully it helps you understand the context of price action. Why do penny stocks and cryptocurrencies tank into the end of the year? And then also too, remember we had to stamp on every single piece of marketing material that went out when I was a commodities broker. Past performance is not indicative of future results. Well, what does that mean? Well, it means like we might have years like this year, where the whole market heads into a big orgy up, into a massive long-term cycle peak. Just like in 1980, gold prices went straight up into that event. It looks like Bitcoin and crypto went straight up into this fear cycle pivot. So sometimes seasonality can be put on the back burner in one market or another because of external forces. So I hope you're also learning that valuable lesson. So, but really good information that you need to have in your tool belt if you want to be a professional at this game. You just have to understand there are some times to fight the good fight, and there are some times to just keep your powder dry and just don't do jack shit. And then also too, when you're thinking about pulling the trigger, try and use that information to your advantage. And so, like I said, I was very impressed with the fact that guys like Raph were hunting long ideas in coffee right now. Who the hell's talking? Anybody who's talking about buying coffee right now? I don't hear anybody talking about coffee. Has anybody heard anybody talking about coffee? How many times can I say the word coffee in a sentence? Coffee, 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 coffee. Anyway, actually, this is interesting. Speaking of which, one of our level 2ers happens to live in Hawaii, and that crop is actually in jeopardy because of the volcanoes. I mean, it turns out it's a very, very small portion of Hawaii that's actually blowing up, but it is affecting the atmosphere and the amount of sunlight, and so that might affect the actual coffee crop there. which might have an influencing factor on coffee in general. Who knows, right? You can't write better fiction than reality. The reason why prices will rally here over the next, 6 months or so coming out of the seasonal trough, it could be as crazy a story as that. You never know in this game. Okay, so here we are at week 10 of the program. And this, interestingly enough, is one of my favorite topics in the stock market, because it really speaks to how economies work, and understanding the nuts and bolts of the economic cycle, and how, massive pension funds and stuff like that participate in the market. Interestingly enough, we don't really spend enough time. We introduce you to the concept of intermarket analysis in the level 1 program. But it's just a very tertiary introduction. Dow gold ratios, to tell you about the long-term sentiment in the market, which works really, really well. It is just one example of an intermarket analysis relationship. And then in the level 2 program, we introduce you to the term structure when we introduce you to futures. And you get to learn a little bit about things like backwardization and contango and how that can tell you about the health of markets. So, and of course, we talk lots about things like internal indicators, breadth, and stuff. So you have been introduced to this concept of intermarket analysis relationships, but there's one big part of this conversation that you haven't been introduced to yet, and that's what today's all about. I also, don't, in particular, there's a couple things that I would like to talk to you about today about intermarket analysis that we don't really formally address in the school program. We do have, references and side videos on the site if you want to learn more. And usually when people ask, I direct them to it. But it's not a bad idea for us just to take some time and review some very basic intermarket analysis relationships that you should understand and have in your tool belt. And then the second half of today's class is really the formal introduction to this concept called sector rotation. So without further ado, we're going to be working off of this Google slideshow presentation as always. As I said, we're going to just do a little bit of review just to make sure we all remember what the hell intermarket analysis relationships are. We're going to talk a little bit about our buddy, the yield curve. And as I said, this is sort of our, our formal, introduction to yield curve in the school program. So, if you do have yield curve questions and stuff and in the following tutorials and stuff, this is a great opportunity to review all that. Just make sure you got it down cold. And it's actually interesting because we are hearing a lot more sort of chatter in the marketplace about yield curve lately. So obviously it's got people's attention. Then we'll talk a little bit about the future spreads, again, just a little bit of review, whether it be things like the Pippi spread trade or whether it be, acknowledging backwardization versus contango and the health of the market. And then, as I said, we're going to finish off with sort of the meat and potatoes of today's class is the introduction of this concept called sector rotation. So first things first, what the hell is intermarket analysis? In essence, it is one of the sort of 3 schools of TA. I used to actually subscribe to a newsletter when I worked at one brokerage house, and it was simply called the intermarket analysis of markets. It was just it was the most boring newsletter you could possibly have, right? And all it was just looking at the spreads of one commodity versus another, and what is the economic implications of one versus another. And this guy's institutional letter, I think he sold it for, this back in like the 90s. He sold it for like, geez, easily $500 a month. And the brokerage firm, it was just like hands down, they bought it just because you had to have that information on file. So there's a lot of people that have made like really, really good businesses out of this. In fact, later on when we talk about one particular model, this idea sector rotation, there are like whole mutual funds and whole advisory services built just purely on understanding the relationships of one asset versus another. And, given economic theory, what is the performance of those assets given, historical sort of normals? And where does that put us within the business cycle? Actually, before I forget, I've thought about it a couple times. We are going to have a couple extra links here handy. Alex Dixon, handy, yeah. What? Ryan, you're crazy, man. What do I want? I want... Nope. Got a better way to organize this stuff, I swear. Every time I come in here, it's always the same damn thing. All right. Yeah, we want this one. And we want... where is the economic cycle? Business cycle. All right. So before I forget, I wanted to make sure we had those. Move that over there. Actually, we'll put you here and here. Okay. Back to your regularly scheduled program. So we remember back in level 1, we said that the relationship of one asset versus another can tell us about sort of things like demographic sentiment and the Dow gold ratio. That was sort of the big takeaway out of the level 1 program. We could also look at intermarket analysis relationships, say between the number of stocks that are advancing on a stock exchange versus the number of stocks that are declining. And we can plot those numbers, and that can tell us about the general health of the stock market, i.e. what we call the breadth. And one might argue that, I keep pulling up all these pages. One might argue that's what this is basically here. This image is in essence, oh, if it'll load, there we go. This image in essence is the breadth of the stock market, and this is just simply a measure of how many stocks within each of these respective universes are giving short-term buy signals or sell signals, and how many of the stocks in the respective screen are giving short-term sell signals. And this is the medium term, right? Short term, medium term. And this is in essence like a bullish percentage index. A perfect example of intermarket analysis relationships. Has absolutely nothing to do with any one particular security. Has everything to do with the relationship between all of the participants in the market. So, our simple premise here is it can be the difference between two similar assets. Right? Say like two futures contracts, forward backwardization versus contango. Can be the difference between two completely non-correlated assets, hard assets versus soft assets, Dow gold ratio, basically should move in opposites. What's really cool about intermarket analysis relationships is the information gleaned from one source can actually be used to tell us about the health or ill health of another market. For example, like the yield curve, right? Yield curve has technically absolutely nothing to do with stocks. Really, the bankers, they don't even give a rat's ass about the stock market. Most of the bankers actually don't like the stock market. And, when I was actually originally writing the level 1 program for the Canadian Chartered Accountants Continuing Education Program bullshit, the irony of most sort of good accountants, good bankers, is they're more than happy with a nice 2-3% yield. It's guaranteed, principal's guaranteed, right? Term deposits, GICs, whatever. And the whole purpose of saving money is to make sure you don't lose that money. So, it's very difficult to explain to an accountant, a banker type, real sort of, conservative, the idea of the efficient frontier. It doesn't make sense to take more risk, actually reduces your risk. But, thanks to efficient frontier guys, they proved it mathematically. I think also, too, what's really important about intermarket analysis relationships is it's applicable across multiple different time frames. So, I suppose you could argue you could not only take like longer term impressions of markets, like especially when we do things like COT reports. But I know lots of people that use breadth data, for example, to help them time stock market entries and exits. You could argue that something like the short-term trading index on the NYSE, or what they call the ARMS index, is nothing more than a intraday tool. There are a lot of people that trade the VIX, right? And the VIX is nothing more than a relationship of implied volatility, which of course all you know about now. So the point is that this is an extremely robust part of the market. Whole careers have been built on analyzing the relationships of assets between one and another. And as we're going to learn later on, there's actually whole sectors of our economy that are driven by this intermarket analysis relationships and very conservative, billion, if not trillion-dollar funds. They set their watch by this shit. So if they're doing it, as a robust market participant that you are now, it's probably in your best interest to at least have this in the back of your mind. Okay, so a very simple example of intermarket analysis, which we all should be very familiar with, and we talk about on the site quite a bit. We also have put together if I'm not mistaken, a nice little video, how markets work. Is that in here? I'm talking a little about the yield curve and what does the yield curve tell us and tell investors. So, I'm not going to spend too much time on this today, but the long and short of it is that if we actually think about the economy, everything moves in circles, right? And I pulled up this image before we got going here in earnest to just talk to you a little bit about this one. Everybody understands, we just did seasonality, so everybody understands seasonality. There's also the business cycle. And the easiest way to actually follow the business cycle is just put on a 200-period weekly moving average on your charts. And it's remarkable to see how the market always comes back and checks this. And then within this next wave, the economic cycle is this business cycle. There's actually it should be like 8 to 10 years. And these business cycles should be like 4 to 5 years. So they often, it's interesting how I have year ads there. Then I just noticed that now. Nothing can possibly go wrong. That's the first time that anything has possibly gone wrong. Anybody remember what that's from? Anyway, the point of the matter here is that to actually see this economic cycle, the whole 10-year cycle, what we do is we break down that from sort of peak to peak. These are sort of your business cycles within the broader economic cycle. So this would be like, I suppose you could argue that this should be the 10-year cycle. And then within here, there's like a sine wave that goes basically every 4 years. I think I got that right. I might have that backwards. I think it goes up and then down one full cycle in here would be the business cycle. point of the matter here is, looking at the economic cycle, it moves in an extremely predictable manner, right? And you always hear me on the site talking about more decades that usually that end in years that end in 8s, 9s, 0s, 1s, and 2s. The odds of recession are extremely high. I don't see any reason why this should be any different. Usually there's like sort of a semi-tightening cycle halfway through the entire business cycle. But one might argue that due to the severity of the and you guys know the fear cycle apex, the end of this demographic crunch. We've gone into extreme, because the baby boomers are such a big generation. We've gone to absolutely extremes. In the interest rate market and stuff like that. So this cycle's been a little bit skewed. We haven't really seen that mid-cycle pivot, but I definitely feel like you can feel that, the recession is coming, and it's going to be a big one. We also, of course, have a Jupiter-Saturn cross in 2020. So my hunch is the big orgy is somewhere between that Q3 2017, that was the sort of official end of that last fear cycle, and that Jupiter Saturn cross period. Somewhere in all of this mess, there's going to be one hell of a recession. So it's coming, and it makes sense. Here we are, 2018. Go back in your history books and look, and you will see. And the interesting thing about this is actually, if you go back, the absolutely most accurate predictor of those recessions has been the yield curve. It basically every, decade heading into really coming out of the Second World War, the Federal Reserve has been, when they were, and here's the problem with the Federal Reserve is it an independent body where it can act in the best interest of sort of the money supply, or is it a politically controlled entity? One might argue that the inflationary spike that we saw in the 1970s and what ultimately ended in the war on inflation by Volcker in the 1980, 81, 82 period, that was a reaction because the Federal Reserve went very dormant in the late 60s and early 70s because of political pressure. Tricky Dick, he, and hopefully everybody remembers this from the level one, he saw what Herbert Hoover went through, and he did everything he possibly could to prevent that same situation. So he took the US dollar off the gold standard in 1971, right? And under normal circumstances, that would have created inflationary pressure, and the Federal Reserve would have come in and raised interest rates to defend the currency, and that would have put the kibosh on the economy, and down would go stocks. But Mr. Nixon had incredible political power in Washington. And it was sort of the end of the despotic U.S. presidents, because following the Second World War, and especially through the election of Eisenhower, because remember, he was like a Second World War hero, in invading Western Europe and liberating Western Europe, blah, 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 blah. He was like the ultimate Cold Warrior, right? The U.S. president, in a weird sort of way, became extremely powerful. And remember, Tricky Dick was Eisenhower's vice president. In fact, Tricky Dick lost to Kennedy, and that was a very famous election in 1960, I think it was. I think it was 60. Late 50, 59, 60. So, Eisenhower and then ultimately Nixon, exerted incredible political pressure on the Federal Reserve, and so as a result, they didn't raise rates because they wanted to, inflate the economy so the stock market wouldn't crash. Yada yada yada. And as a result, we got that sort of runaway inflation problem of the late 70s. And then that translated once sort of Nixon was gone and the Fed sort of was given carte blanche by the politicians to try and deal with inflation. Into that cycle peak, 79, 80, the Fed just put the kibosh on the economy, just killed it, raised rates to double digits. That killed inflation. And, one might argue that was sort of the beginning of the end of that commodity cycle, and even the demise of the Soviet Union. Anyway, the point of the matter here is if we were going to look at the market for any sort of indicator that the recession is going to come, the yield curve is by far the most powerful tool you can have in your back pocket. Under normal circumstances, the curve here rises over time, and this is sort of the financial services industry's profit margin. They lend to the public on the long end, then they go back to the Federal Reserve or whatever they call it, the discount window, whatever, and they just keep borrowing those lending money that they lent out on the 30-year up at this rate. They just keep refinancing that debt on their balance sheet off the 90-day rate down here. And of course, the spread is their profit margin. So the key here is that because short-term interest rates are set by a sort of central authority, it gives that central authority the ability to generate recession in one particular sector if they so choose it. They don't have to raise rates, but if they feel like the purchasing power of the currency is being eroded because of inflationary pressures, and some argue that inflation is nothing more than just the velocity of money. The guy who's actually Donald Trump's economic advisor right now, that's his basic mantra, is that inflation is a function of the velocity of money. So if the Fed wants to slow down that money transacting, they can just simply raise the cost of borrowing in the short end, even up to these kind of levels, where the financial services industry go, well, we could lend to the public, but we're going to have to borrow here, so there's not much of a profit margin into that. Maybe we won't do so much business. And in fact, and that's what they call a flat curve, where, they're just the Fed, the central authorities, they want to put the kibosh on it. This is going to slow the pace down. In this scenario, if they actually take short-term interest rates above longer-term interest rates, this is what we call inverted. In essence, now, whatever lending the financial services industry has done in the past, well, because short interest rates are so high here, they are pretty much guaranteed to lose money. Yeah, in essence, it's a manufactured squeeze. Now, the problem here is that this is a very, how do we say this? A squeeze is the correct phraseology here, Warwick, and nice to see you, dude. What I want to show you guys, though, is, sometimes the central bankers really don't have any choice. And what we have to understand is that I should have had this loaded up. Sorry, guys. Here we are. What we have to understand is that the Federal Reserve is considered sort of the lender of last resort. But there are some times when the lender of last resort has no choice in the marketplace. And so, interesting enough, this is another form of intermarket analysis relationships. This is what they call the TED spread. And it used to be the T-bill rate over the euro dollars, hence T-bill, ED, euro dollars, ED, euro dollars, TED spread. That sort of changed. You don't hear people talk about the T-bill rate anymore. And I think that's because, as T-bill rates, go down, especially in the 2007, 2008 financial crisis, T-bills really were, the impetus, especially following, especially guys like Alan Greenspan, the impetus for it changed from using T-bills as the benchmark rate to what are called Fed funds. Because instead of, T-bill implies U.S. government, and the funny thing is the U.S. Treasury is in a really bad spot right now, right? They are issuing way more paper than they're, issuing in, I guess. Massive deficits constantly. So we can't use that as a benchmark. Who's actually backstopping the market? It's now the Federal Reserve Board. And the Federal Reserve, as a function of the sort of banks, they're the ones that actually had to take the bad debt. The U.S. government did not take the bad debt back. It was the Federal Reserve Board that took the bad debt back. And basically that bad debt is just sitting on all the banks' balance sheets. That's convoluted, but the long and short of it here is that sometimes the Fed, as represented by the Fed funds, it actually is subject to the forces of the market. And the euro-dollar market is huge. It's massive. We talk about the derivatives market, and this is kind of off topic, and just imagine that. Brian's actually going off topic. Sorry, guys. I love the sound of my own voice. And maybe I might even put you to sleep. If I do, I apologize. But if we go to the euro dollar markets, we see here is euro dollars. This is this is not the euro currency. That's sort of something that's just been created since the turn of the century kind of thing. This is the corporate borrowing market. It's always been called the euro dollar market. It's in essence the short-term interest rates without the Fed's participation. This is all like corporations lending money to each other. And in essence, this chart you see that I had there, where the hell is it? This euro dollar, that is the interest rate that corporations charge each other to borrow money. And somebody had made reference earlier to a credit squeeze. Well, interestingly enough, usually the credit squeeze is started in the corporate market. And if the Fed just ignores the squeeze in the corporate market, then the TED spread just explodes higher. And if the TED spread, or the old rule about the TED spread is, if it gets above 1.0 or a full percentage point between the corporate interest rate market and the Fed funds discount rate, which you can see right here, you see where it jumped up to above 1? Look what year it is, right? This is financial asset crisis. So this is a visual demonstration of that credit squeeze. Does that make sense, Warwick? And the interesting thing is a lot of times in the marketplace, Indian, I mean, all of you, I hope that visually demonstrates. This is a great application of intermarket analysis, right? This is just simply looking at the cost of borrowing for corporations versus the cost of borrowing from the Fed funds window. And, this is why through all of this period, they actually let places like Goldman Sachs go and borrow from the Fed funds window and not be subject to the euro dollar market rate. Does it make sense now why There were some companies that were mysteriously turned into banks through the financial crisis. Well, the reason why is because only certain individuals can go to the Fed funds window and borrow from them. So more expensive from the state, usually. The Fed. No, it should be, well, historically, what usually happens is that this trades at a premium. It's just, the key here is you can't let the premium get out of whack. And, in this is a rising interest rate market, because remember, these things are priced. Very simply put, like, these is usually like 1 year paper. And the price, let's say, you can see right here, the price of the Eurodollar is right now 97.69. So if you buy this asset at 97.69 today, and it's a 1 year paper, and it expires at par, right, 100, does it make sense that that difference is your yield? And the inverse of this number, minus 100, are the yields. So, the yields on government paper right now are like the Fed funds is 1 point, what is that? 825. Does that make sense? 1.825. And the yield on the corporate paper right now is what's that? I guess 2.31, somewhere in there. And the difference between those yields is what we call the TED spread. It's a really good example of intermarket analysis relationships. And if anything, like we said, you can, and really here's the problem for the Fed, right? Is you can either let this TED spread, right? Because these are the market rates, and markets are going to charge what they charge, right? And if the market seizes up, like Warwick was saying earlier, well, then you got a credit squeeze, because the market simply does not want to lend out money at cheap rates. Now, if the Fed says, no, we want to keep rates low, right? We want to keep the economy's just not strong enough to support stronger interest rates, that's going to create the spread widening. And like I said, if we get up to the point where the spread gets to 1.0, all hell breaks loose in the stock market, right? In the economy in general, right? This is your credit squeeze. So if the credit markets, if the corporate credit markets are rising interest rates, do you see how really the Fed doesn't have a lot of choice here? It's not like they can choose not to raise rates. If the market is cranking rates up and they don't, they take the chance of causing a financial crisis. If they do raise rates, though, can you see that what that will do is if they raise rates, that will generate an inverted yield curve, which causes recession, which causes the market to come down. You see how it's sort of like you're damned if you do, damned if you don't. See how fun this is? Right now, you guys now understand how economists work. Do you see why the bankers, all their fucking hair is white? It doesn't matter what you do. You're always going to be, stressed out, totally. I hope that, and the irony of it all is that when I try to tell this to the public, when I try to explain this to the public, they just don't get it. It's everybody loves to get angry at the Fed, but the Fed is just simply a bitch of the market. All right, so the point here is, and hopefully you can understand this now. Do you see how if they can generate, and like I said, they might not have any choice, but if they can generate a recession in the market, right, in one particular sector, That's going to cause the market to top out. And in, say, the financial services sector, maybe they start laying off employees. They start, less perks, right? Pull back the salaries. That, of course, snowballs into other parts of the economy, less lending, right? And that generates the slowdown desired to cool down inflation. We get to the point where, okay, we've achieved breaking inflation's back. The data is coming in. The prices are not rising at an unsustainable pace. In fact, they might even start to fall. And now the Fed can start loosening that inflation or that high interest rate, short-term high interest rate grip. Where the hell are we? That's one of these pictures. What am I trying to show you? Nope. Yeah, here we are. Well, fudge. I lost my train of thought. Okay, so yeah, here we are. So they can take the yield curve back down, right? Because they have the discretion to raise or lower interest rates. And really, we'll also see this. I don't think, I don't have an example of it here. But let's see if we can show you. So it would be really cool to actually, let's go and see here. So do you see October 2008? That's basically the absolute widest that this spread got to. So if we go and look at the S&P 500 in October 2008, we should see that basically should mark a sort of capitulation bottom. What are we going to do here? I guess, well, we could probably just overlay this. Let's see what happens if I go SPY. All right. So market goes into financial asset crisis. Oh, sky's falling, right? Stock market's melting down. So at this point, right, where you can see stocks are just on their knees, and this thing starts to top out. And can you see that the stock market actually started to come back when the market got this resolution back below 100? Can you see that? So the market came down into 100, rallied away. You can see the cute little M right here that basically marked the bottom. Do you see that? Oh, excuse me. Right? That, in essence, that M right there. I mean, you want a fucking timing signal to when to buy the stock market. Can you guys see the spread there? It was like up. Oh, here we go again, back into crisis. Right? And you can see the market's tipping over, and then all of a sudden it goes, no, I'm okay. And that was the bottom in the stock market. You see that? Pretty good analogy there, right? And of course, that's on the resolution back below this 100 level. Okay, we're out of crisis. In crisis, oh, fuck me, right? Resolution out of crisis. This thing is indeed broken. Everything's all tickety-boo. And that, even just the breakdown here, break that uptrend line. Probably the market was convinced that this up move was done right through here. In essence, that marked the bottom in the market. And also, too, remember, this is when Obama was first elected. Right? His election was right here. He appointed the new sort of Larry Summers and Geithner, I think the guy's name was, Bernanke, to sort of save the U.S. economy. They created quantitative easing. They bought back AIG, all that shit, right? Democrats, socialist policies, blah, 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 blah. The market was like, okay, all right, the bad paper's gone, and we put in the bottom. So a really good example of that. And also, too, right, you can see the spreads, right? Here's the Fed funds. They basically cranked them down as hard as they could. The question ultimately was, is the short-term interest rate market relatively happy? You can see that, yeah, the euro dollar the corporate short-term interest rate market was like, okay, yeah, we'll follow your lead. Okay, all right. And then they started go, okay, well, and notice that, of course, is right around when Obama just first got elected and took office, right there, beginning of 2009. they were like, okay, now let's see if this guy's for real, right? Is he really going to save the market? So really good analogy, history story there as well. Okay, so I hope you guys are enjoying this presentation on the yield curve and intermarket analysis. And actually, we had a really good conversation here today about the TED spread and how we can use the TED spread as an intermarket analysis tool to help us time stock market purchases. As we've talked about at length, we can use futures spreads as sort of our in a weird sort of way, it's kind of like your TED spread kind of concept, but just asking a market itself internally, are you happy or are you unhappy? We don't necessarily need to go into all of it. You guys remember the Pepe spread? Do we need to go back over the Pepe spread? Anyway, on people's perception of backwardization and contango in the marketplace, there is, I think I might even have it in here as a saved one because we just did it recently with the kids. I don't know whether I saved it or not. It was on corn. Nope, I don't see it. That's too bad. Anyway, by all means, if you want to revisit the Pepe spread and look at contango and backwardization through this week and you have questions about it, feel free to ask. I have been blabbing away here quite a bit, so we haven't really gotten into what I really want to talk about today. So I think we'll leave just the basic Pepe spread. I think I may need to go over that contango backwardization. Well, actually, I did up a really cool chart, but like I said, I didn't remember to save it. That was pretty stupid. We went like so. And we go like CZ1. Well, maybe we'll do it manually. So we'll say new crop. Well, let's do current crop. N8. So this is heading into this year's harvest. It's the end of May, so this contract still has a little bit of life left on it. Futures. CZ. What is it? Maybe it's ZC. There it is. N. All right, that's the one I wanted. And then we'll put on, say, ZC Z for the new crop. 8. No, weird, it doesn't do that. Do I have to go 2018 like that? Oh. All right, so there's December. And then we can do ZC, I guess we got to go Z 2018 minus ZCN 2018 for a spread. There we go. So here, and I don't know, you don't necessarily have to do it this way. You can actually separate them. Actually, that takes a lot of space up, doesn't it? I don't think I like that. I think I'd rather do it the other way. Oh, new chart. Get rid of this. So we'll go ZC Z 2018. Okay, there's the spread, and then we will go ZC and 2018 and ZC Z. All right, that didn't take too long. And then we will go unmerge down and unmerge down. Okay. Oops, there. Okay, so here's your two contracts. We've got the December and we've got the July. Here is the spread. And if we listen to the market's message, well, it's pretty straightforward. Are we in contango or backwardization? Actually, this is kind of cool too. You can see that we were actually in backwardization here for quite a while. Yeah, right all through here, backward. Yeah, backwardized. Gone into contango here, so I guess the market is feeling better. We've got spot prices 406, and we've got the new cop prices 4.25. And in essence, you can play the health of this market just based purely on the spread trade. And really, I think there's probably a pretty simple trade here. Probably a lot of people in industry took this trade. Just simply on this breakout, and even you could even argue there's another cool trade right here. Right on this breakout right here. You're going to buy the December and sell the July. I guess that was through there. Interesting, this spread prices actually fell, but because you bought the December and you sold the July, you actually benefited from the fact that the market actually fell in price, but your spread trade actually still made money. Eh? See how that works? So, excellent comment, Warwick. Warwick says in the lounge here, it was interesting how just before crude broke at his harmonic level, the market went into backwardization, which clearly meant that it wasn't very happy up there, right? So fascinating. Okay, so if you want to talk in the tutorial sessions a little bit more about spread trading and intermarket analysis, basically telling you about the health of the corn market or whatever market you're interested, feel free to ask. Okay, let's keep moving this train forward. Of course, we also talked a little bit about some of the classic Dow theory signals. This has been around like 100 years. I think it's a fabulous tool to sort of give you an idea of what the stock market's got planned for us going forward. Transports need to confirm a breakout in the industrials. My hunch is that I can see that the stock market is trying to break out to new highs here, but my hunch is the industrials, the transports are not going to confirm that move. So if we go say the yummies, YM1 exclamation. I don't even know if there is a transport index, so maybe why don't we just stick with cash? DJIA. All right. Well, the Osaka exchange. That's weird. How about index Dow Jones? Okay, am I stupid? What's going on here? The ETF. There's the transports. That's what I want later. Okay, why can't I see it? It's like INDU, isn't it? Oh, what the hell's the damn symbol for the Dow? That's funny. Dow Jones Industrial Average, DJI. Oh, that's close. Anyway. Okay, so let's keep a close eye on. Maybe we can just do this as a line. On the transports, confirming the industrials. Okay, so this is the industrials. The yellow is the industrials. That's right. Oops. Oh, crap. There we go. Looks like the transports are moving higher. So I think we can justify the move higher here in the Dow. And what you'll often see is here, for example, the Dow broke out to new highs. The transports did not, and the industrials had to take a pause. I don't even know whether you remember this from the level 1 program. Do we have another one here? I seem to recall, the actual top here. I suppose this one's a good example. Right. Transports never did break out. Industrials did break out. Transports actually just totally crapped out. Industrials sort of bumping away here. And eventually, they keep trying to break out, but the transports are just not happy. Eventually, the industrials have to play catch up. It's a really good example of intermarket analysis relationship. Okay, so we could go through them. I mean, there's bazillions of them. Hopefully, you guys are, this is just a nice, simple, review of all this information. If there was anything, that you were like, yeah, Brian, I remember I had a question about this that I never got to ask you before. Feel free this week to dig into that. Okay, so let's dig in particular, let's really spend the next sort of half hour, 45 minutes or so teaching you the sort of meat and potatoes of today's class. And that is this idea of what's called sector rotation. When I first got into the business, I remember I used to follow this guy, Sam Stovall. Try saying that's 10 times fast. I think he might even be mentioned in these articles. He was sort of the first Wall Street, well, not really first, but he was the big sort of rah-rah cheerleader of this concept called sector rotation back in the 80s and the 90s. And even his son ended up basically following in his footsteps because the model works so well. These guys, in essence, were sort of like the meat and potatoes. Like they were the source for this model back last century when I sort of first got involved in this business. I don't really hear anybody talk about sector rotation anymore, which I find a bit surprising. Just don't understand it. But in essence, you remember our conversation about the business cycle. And you remember our conversation about how the yield curve, in essence, dictates whether one particular part of the economy or sector of the economy is going to do well or not. That makes sense to everybody? And what you need to understand is that every single different sector of the economy has its own sort of like internal clock, and it's always running. So we've given you sort of the breakdown of the financial services sector, and it's just simply a function of spreads. That's all it is. And, the market whims based on inflation or deflationary expectations are going to set the tone for those spreads. And then, the lender of last resort, the U.S. Federal Reserve Board back in like 1910, when the market was just purely euro dollars, this guy, JP Morgan, had to run around saving the stock market one day when it went into crisis. And he was like, fuck that, man. I'm not doing that anymore. And they created the Federal Reserve Board. So that the irony of it all is that the way that we walked you through the cycle in the financial services industry is no different with all of these sectors. And hopefully you can see that all of the major sectors of our economy have their own sort of classification. And given where we are on this cycle, each part of the economy will either enjoy headwinds or tailwinds. It's really that simple, guys. The irony of it all is most people don't understand how basic this really is. So in essence, what is sector rotation? Sector rotation is nothing more than fund managers. And these guys, these are the pension funds. These are the guys that invest, $100 billion, $1 trillion funds, like massive pension funds. One of the biggest ones, California State Teachers Pension Fund, CalPERS. That's just one, for example, but there's tons of them in the marketplace. In fact, it's kind of sad, but the largest market participant in Canada is the Ontario Teachers Pension Fund. So these are very, very big players. And of course, they can't fuck around with asset management, right? They've got to be properly positioned, given where we are in the economic cycle. So what they will typically do is, and keep in mind, these are the smart money. These are the people that they will pay the $1 million+ for the research. Remember our introduction to the futures market, the whole hedging industry, right? These are the smart money. They are the people that know exactly where we are on, say, the yield curve business cycle for the financial services sector. And they will know whether this is a good time for financial services stocks to make a profit, and this is a bad time. And you really shouldn't be in financial services stock because they're like guaranteed to lose money. So what they literally do is they just shift the money that they're asked to manage from one sector to another based on where we are on this economic cycle. And in essence, and really in simplest terms, it just simply is basically the buying of one asset sector and the selling of another. A lot of the mutual funds out there will actually let you move from one sector to another and not incur any commissions or any fees. So I don't know. I think Warwick, weren't you saying that you read the Market Wizards books? There's one guy in there who is just all mutual funds. That's all he did was he had all his money in a fund, and he had like a light board, and he just had basically like lights lit up for the different sectors, given watching the big portfolio managers just simply shifting money out of one sector fund and into another. Do you remember what that guy's name was? I want to say Bill Lipschitz, but I'm not positive on that. What a name, eh? Lipschitz. You never hear that name anymore. Lipschitz. Yeah, totally, eh? Anyway. I guess the easiest way for us to understand this is, like I said, first and foremost, these guys can pay the serious money to know which sector is going to be outperforming and which isn't. And interestingly enough, in say like a rising interest rate environment, that's going to kill financial services. But why would interest rates be rising? Usually interest rates are rising because the economy is really hot. So if we see that financial services stocks suck, we probably should be able to go out and look out of the market and see which sectors are actually doing well. And this is the weird thing about capitalism. It's like this thing that sloshes. Remember the lava lamp, right? Capital is neither created nor destroyed. It just simply sloshes around the system. And sadly, of course, the public is usually buying the asset that these guys are getting the fuck out of. And often, and so if we think about, like if we look at this bottom image right down here, in fact, actually, I think I have this. Yeah. Nope, that's not it. Where the hell is it? All right, it's around here somewhere. Oh, I thought I had it on here. There it is. If we look at this image in particular, you'll notice that the sectors are labeled across the top. And we have two curves here. The first curve is the red curve. And we have to understand that the market always is, the stock market is the ultimate leading indicator. Have any of you ever heard me say that before? It's the ultimate leading indicator. And of course, if a company is perceived to make money. Do you guys remember the forward discounting mechanism story from the level 1 program, right? With the widget factory. Did I do the widget factory story with you guys? If you can remember back to that story, then what we have to understand, because the market is a forward discounting mechanism, stock prices and their asset prices will actually lead the economy. So the red line is the market. The green line, the second line, is the economy. So as you notice, like this, the market starts moving up, right? The economy is revving up. The stock market is rocking and rolling. And then eventually it sort of drags the economy up with it. So you see that these are just slightly skewed. So what often happens, of course, and just think of it in simplest terms, in a full-on recession, of course, the public, that's where they're most pessimistic. They've gotten completely wiped out because they bought the top and everything has come down. That's, of course, when markets bottom. And markets, of course, bottom through the process that, think Wyckoff accumulation distribution. The public is distributing the assets that they bought up top, and they're usually selling it right back to the smart money. So through that process, and then the smart money, at the bottom, all the risk has been taken out of price. So smart money starts coming in and buying again, and the Wyckoff process starts kicking in. Usually what happens through this period, of course, is that the Fed has cranked interest rates right down to nothing. They've basically guaranteed profits in certain areas of the market. And of course, through this period here, this, interesting enough, is when technology stocks do relatively well. And interesting enough, cyclicals do really well. Now, why would that be? Well, the point here is that the market's washed out. All this speculative fervor is gone. And, basically premium's been taken out of the market. And what grows the fastest? Well, technology usually grows the fastest. And in essence, you get investment in sort of productivity, because now interest rates are really low, right? If companies are going to invest, they're going to invest in things that make them more productive, increase their profit margins, yada, yada, yada. Cyclicals, in essence, this is almost like a conservative play. That cyclicals, they're just going to follow the economy. And if the economy is in full recession, then in essence, these things are absolute worst. And as we come out of that full recession and the market's bottoming, these things are going to reflect that growth in the economy. They just simply, that's what cyclical stands for. They are like the big industrial names, that kind of stuff. In fact, here is industrials. They often are right with it. Now, you'll notice that the market starts moving up in earnest, right? We start actually entering a bull market. We've got technology, we've got cyclicals, we got industrials firing on all cylinders, and you start to see that the economy itself starts coming back. And, this is often where materials and energies and commodities start catching a bid, because now the economy is starting to come back. What's starting to grow again? Inflation, right? So energies, materials, commodity prices, they should start going up as inflationary pressures start building, as the economy starts coming back. Once we sort of, and this is the sad part for the economy, of course, is once we hit this sort of cycle peak, the economy's in full ramp, what's the Fed going to start doing? They're going to start raising interest rates. And in essence, this is usually where the market itself starts topping. So if we start seeing materials and energies outperforming, then we ought to start thinking, market top's probably coming. Market tops, right? The economy, of course, is in full-on recovery, the consumer's feeling pretty good, but remember, that's not usually a good time to invest. Prices think Wyckoff, prices are bid up, right? And of course, inflationary pressures are rising. The Federal Reserve's starting to raise rates, and they're actually starting to invert the yield curve. So what ends up happening, of course, is, people run out of, economically sensitive because we're at the top, and of course, interest rates are rising. Financial services are guaranteed to lose money, yada, 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 right? We're at the top. People run into things like Heinz ketchup, right? Clorox bleach, because you're absolutely going to have to buy these things regardless of how the economy's doing, right? What they call consumer staples. Tide laundry detergent, right? As well. Healthcare is sort of insulated from that economic cycle kind of talk, right? We've got interest rates rising. The Fed wants to generate recessions in sort of financials and stuff. Bonds usually, interest rates are going up, so the bond market's not very happy. But healthcare is if people are dying and they have to buy a pharmaceutical to stay alive, you remember that Schreckle guy and all the negative karma he generated by buying these pharmaceutical companies and then just cranking the prices up, right? Well, the irony of it all is that pharmaceutical stocks are kind of technically immune from the economy. So as a result, when we're going through market top, bear market, the Fed's trying to break the market. Now we're heading into early recession. The economy's slowing down. Financial services are laying people off, right? Mills, banks, for whatever are closing. Healthcare often outperforms. Then the market, is washed out, right? The Fed's cranked interest rates up. They've broken the economy. And now, with interest rates as high as they possibly can go, the economy's broken, the stock market's broken. You see how we can start the whole interest rate cycle all over again. So at this point, with the interest rates absolutely as high as they are, and the situation as worse as it possibly can be for the financial services sector, obviously financial service sector stocks are in the shitter. Right now is the time when you invest in financial services, and you should start to see financial services outperform through here. Does that make sense, guys? Do you see how the economic cycle works? That's like economics 101, a whole fucking year's course right there in 10 minutes. Okay, so the point of the matter here is that this is the world that we live in. This is the way the market works, and there are fund managers that will simply hop from one sector to the next. And keep in mind that these are the smart money, right? And they manage billions, if not trillions of dollars, and they pay people to make sure that they are in the right sector given where we are in the economic cycle. Now, remember I told you there was a newsletter that I subscribed to, and there was like $500 a month back in the 1990s. All right, it's probably like $1,000, $2,000 a month nowadays. Why would people pay for such an expensive newsletter? Well, it turns out that they did a study. And, I don't even know if they're still in business. This is like 20, 30 years ago kind of thing. But the study works, and I followed it for years, and I'm not here to reinvent the wheel. I'm just simply here to figure out what works and what doesn't, do more of what works and less of what doesn't. So here's how the study goes. It turns out that mutual funds, especially big things like pension funds, they get given money to invest on a regular basis. Does that make sense? Right? Teacher goes and teaches class, collects paycheck every 2 weeks. Small portion of it goes to their pension. Now, it's not given to the fund managers in just sort of dribs and drabs. What ends up happening to try and, be most efficient is that these funds accumulate on a quarterly basis. And then the beginning of every quarter, those funds are released to the fund managers, and those fund managers are tasked with investing the money. They have no choice. The money must be invested. Does that make sense? Anyone? It's a pretty important concept, right? I mean, this is understanding the nuts and bolts of the way stock, the stock market works and why it works. So the point of the matter here is we have a massive industry, pension funds, mutual funds, all that shit. They're given massive amounts of money on a quarterly basis, and they have no choice. They must invest the money. Now, if somebody's holding a gun to your head and says, you must invest this money, do you think it's worth your while? This is like billions of dollars. Is it worth your while to maybe spend a little money on research to make sure that you put the money to work in the right place? Given where we are in the economic cycle? I mean, if you get this wrong and you lose the client's money, you're not going to be in the pension fund business for much longer. I can absolutely guarantee you that. So these funds have massive amounts of money that's plunked on their desk on a quarterly basis, and every first 2 weeks of those quarters, they must act. Why 2 weeks? Well, just give them, it might be like several, it might be hundreds of millions of dollars, maybe tens of millions, whatever. They're never going to go in and just buy one lot. Usually they go in and buy chunks. And this study just sort of figured that the best sort of reporting window is those first 2 weeks of every quarter. And especially around things like year end, sometimes you get some sort of, hiccup around the 1st, 2nd, 3rd, 4th of January kind of idea. Maybe the week starts late, people coming back from the holidays. Takes them some time to get going. So what we really want to do is we just want to watch the general tone and the general money flow for those first 2 weeks of the quarter. Now, when we do that, what we often see is, keep in mind, these guys are expected to know where we are on the economic cycle. So what we often see is that the first 2 weeks of the quarter, money flows will go into one or two particular sectors on balance, and we'll see that in the performance in the stock market. And generally speaking, through the quarter, whatever sort of sector that they preferred generally is going to be the one that outperforms. It's quite remarkable how accurate this is. You are going to have some years that are, and some quarters that are anomalies. But what I really want you to do is I want you to be able to look at sector rotation and let it sort of confirm where we are on the economic cycle. That's really the important message here. So how do we build these studies? Well, this is one of, I've told you before, this is one of my favorite sites. I like to use it. If you need to resize your window to make the histogram look a little bit more user-friendly, that's fine. In essence, it's actually just a straight address. You can all just pop on here right now with me. And what you're going to do, I don't know how it's going to load for you guys, but the default sort of setting they have looks like this. And you'll see that I have a very short reporting window. I think that the default that they actually set the system to is like 200 days. So you're probably going to load up your page, and it's going to look something like this, right? A whole bunch of gobbledygook. You can choose a whole bunch of different sectors, right? They've got a whole bunch of different studies. You could do, U.S. market overview, treasury bonds, right? S&P market capitalizations, even some of John's favorite studies, as well as you can see major industry groups. You can build this any way you want it. I find that it works very well if I just select S&P sector ETFs, right? And I don't know whether it's defaulted for me to this histogram, but this is the way that I want you to use this tool. And you see that you have a choice of doing line or histogram. We're going to use the histogram. So you've got your chart up here, and it looks sort of like this. Now what you need to do is the first step, and we can do this current quarter, and it'll just sort of set you up. You have to go to your calendar, and you have to simply say, okay, what was the first week of this current quarter? So right now, first quarter ended March, so the first 2 weeks are going to be the first 2 weeks of April here. So my study, obviously the first is going to be closed. The study probably should go to the 2nd all the way to the 13th. So I'm going to go down to this little, it says 200 days there. I'm just going to go down here and I'm going to click shift and then left or right arrow, and that will move the first date in your study. So you see how the first date here is changing. And I'm going to bring it all the way to April, the first trading day of April. So see how I did that? All right, so that was shift and then the arrow key. To move the right-hand side of the study, I'm going to click control arrow key, and now that moves the right-hand side of the study. Hopefully everybody sees that. And as we looked at our calendar, we said that the 13th was the last day of that week, and you can see how the next week jumps to the 16th. So here is our study for the first 2 weeks of Q2 2018. Does everybody see how I did that? Pretty straightforward. Now, is there any particular sector here that it appears that the smart money put some money to work in? It's pretty obvious. Very good, Warwick. Warwick's the only one who got it. Does everybody see this big black dildo here? And interestingly enough, what's the second leading performer? It's materials. So do you see that first 2 weeks, the predominant money flow was into materials and energy. And more importantly, money was flowing out of utilities, financials, and industrials. And really, I would say, most importantly, out of utilities. Does everybody see that? At this point, right, we can just simply say, all right, if these guys are correct, and of course that's a big grain of salt, but if they are correct, where do the fund managers think we are in the business cycle? And we go back to our business cycle image, and we say, okay, it looks like materials and energy are right here. We are at a market top. Does that make sense? It says that the economy is ramping up. So what should the Fed be doing through this? Lowering rates? With the economy expanding? Raising rates. Very good, Mark. Very good, Jason. Very good, Ralph. Very good, Thomas. Does that make sense, Kevin? And so the question ultimately is, what is the Fed doing? Is the Fed raising rates? What? The Fed is very much on a raising rate path right now. No doubt about it, Warwick. In fact, didn't the Bank of England just raise rates? Seems really odd considering Brexit. I think they've been raising rates. Remember, our Warwick, were you here when we did this study here? I mean, you tell me, which direction are these things going? Where are we? Our Remember, this is the moves inverse to rates, right? These are the price of the bonds. Were you here when we had this conversation earlier? I know you joined a little bit late. Yeah, you were here. Okay. Well, so you guys tell me, which way are interest rates going? And does that make sense given what the fund managers are doing with their money in the marketplace and where they think where we are in the economic cycle? Do you see how everything sort of is correlating here? Does that make sense? And I'm not speaking just to Warwick. I mean, how about you, Greg? You're awfully quiet there. Do you see how everything correlates here? So we can get a pretty good, we can get validation of Fed policy. Well, it makes sense what's happening there. We can get a pretty good idea of where the smart money thinks the economy is. And I think this is, this is about as blatant as it gets, right? Does it make sense? Money's flowing into energy. I mean, when I look at this study, maybe because I've done this for so long, I look at this and it's just like, holy shit. I mean, this is a one-way market. And more importantly, like I said, if the Fed is raising rates, then does it make sense that the utilities, right, they are exactly where we do not want to be investing. We want to be investing where the market is hottest. These are the companies that are going to do best. These are the companies that are going to do worse. So in a weird sort of way, seeing that the utilities are getting their asses kicked here, we should look at this and go, okay, well, that's also validating that we're at the top of the cycle. Does that make sense, guys? In essence, this is, you guys thought I'd given you the secrets to the stock market. We're now starting to give you the secrets to the stock market and the economy. This is an incredibly powerful module. Very few people appreciate for how powerful it is. So let's take a little walk through history. So theoretically, like we said, we're probably right about here right now. Does it make sense? Yeah, to a certain degree, technology, and that would make sense too, right? Because let's go look back, say, 6 months ago. So here's October, the first 2 weeks of the fall, Q4, 2017. So can you see how technology outperformed in that first 2 weeks of the fall there? It's interesting how utilities were doing okay, but when I see energy dramatically underperforming, and I see things like healthcare and financial services underperforming, when I look at this and I see technology dramatically outperforming, I'm thinking that the fund managers think we're sort of like right here. So we don't really want to be in healthcare or utilities or even financials, man. That's not so bad, but if technology is outperforming, then it's sort of saying that we're right in this area here. And of course, Bitcoin going absolutely crazy into the end of the year, that would correspond with that sort of technology flow. The interesting thing is, let's see what actually, so this was the first 2 weeks. Let's see what actually happened through the whole quarter. You're going to see that it's not exactly the same. Remember, this is just us listening to the first 2 weeks of the quarter. So let's go see what actually happened through the quarter. So what actually happened through the quarter is now, can you see financials and cyclicals and technology were the outperformers? Going back to our cycle analysis, technology, cyclicals, and financials were outperformers, so we were most definitely right here in the cycle. You see how that works? This was the actual data from the whole quarter. Boom, boom, boom. And healthcare and utilities, stay away from them. So we are definitely not in this part of the cycle. We are over here, here, and here. So that's now at the end of the year. So now we go and look, okay, what are the first 2 weeks of the Q1 2018 going to look like? Q1, first 2 weeks, interesting. Technology didn't do so hot, did it? We see that cyclical still saw some money coming in. Financial still saw some money coming in. It'd be interesting to see if there were any outliers, reasons why that happened. We can see utilities are very out of favor, but interesting, look how industrials, and there's our buddy energy. So if we look at the first 2 weeks, the fund managers are thinking that we're sort of, here is industrials, here's energy. They're kind of thinking we're getting to this point in the cycle. Do you see how they jumped forward there? So now, the first 2 weeks, they're thinking now we're in this part of the cycle. And then remember, like I said just a moment ago, the first 2 weeks of Q2, where do you think they think we are in this cycle? Looks to me like they now think we are very comfortably right here in this cycle. Now, the question ultimately here for you guys is, okay, this is the first 2 weeks of the new year, and keep in mind there is some, shenanigans in the market because it is the beginning of a new year. Remember Brian's January barometer kind of talk, that kind of stuff. What happened through the quarter? Does it validate what the fund managers are thinking? So this is what happened through the entire quarter. Oh, well, in reality, the market still thinks that we are over here. You see that? Technology, cyclicals, financials. This is what the fund managers thought. They were thinking, maybe we're a little further along. In reality, nope, we're still very much cyclicals, technology, financials as the outperformers. We are still stuck in here. So it's weird. You can kind of see that the financial services industry thinks we're a little bit further along the curve than what the data itself is actually validating. So we really want to watch how these materials and how the energies do. We are now, what we should be doing now is saying, all right, we are, of course, fairly along this quarter. So there is April. And we really want to be watching. All right, so there's the beginning of April to where we are now. And can you see how the market is starting to validate this, energy and materials thesis? It's no longer interested in financial services and utilities. Remember, financial services had broken. Cyclicals and tech are still seeing money flow in. So in a weird sort of way, but because energy is so strong, and let's watch, of course, if energy just totally breaks apart here, right, and this bull market lands flat on its face, then this is going to crank back down, and it means that we're still probably in this area, right? So do you see the difference between what the fund managers are thinking and what the market is thinking? So, it'd be interesting to see how energy fares. And keep in mind, this quarter still has another 1 month, right? And they always say June's a tough month for the market anyway. April, May, June. So July 1st is quarter end. So let's see how the demand for commodities is through this very tough time of year. If the economy is indeed as strong as the pension fund guys think it is, and if the Fed needs to crank interest rates up. Now, the most recent meeting of the Fed, they did not change interest rates, did they? So you can kind of see there's a debate going on in the market. Well, are we here or are we here? Right? But the long and short of it here is, do you guys see clearly the market thinks we're somewhere in this area on the economic cycle? What do you think, guys? Is that kind of a fun tool to have in your back pocket? And then, of course, we should have been asking, how did energy stocks do through that last period, right? We should be asking, the gold stocks, are gold plays attractive, right? The tech stocks, I still see things like Intel and stuff like that breaking out. And I know one guy in particular, he's been yammering about tech stocks breaking out all over the place. God mode on. Totally. Okay, so your assignment through the week is to replicate this first 2-week study. You should all have this, and if anything, you guys over in the UK, my challenge for you is see if you can create this kind of study on the London Stock Exchange, because there's definitely going to be vehicles on the London Stock Exchange that reflect these different sectors, and you should be able to build sector ETFs to recreate this model. You think you're up for the challenge? All right. For those of you in North America, you got it off easy. Lucky. And if anything, what we should be thinking here is, do we see cross correlation amongst all the data that we're working with to validate what we're seeing? I'm feeling like we're in sort of this kind of area of the market. And seeing that the Fed's been raising rates, seeing that energy prices did break out. Do they hold on to those gains? If they crap out, then it probably means we're not quite as strong in the economy as people believe. And if anything, this also says to me, given that here we are at the beginning of the summer, my hunch is this summer is probably going to be, we don't have to worry about the economy rolling over and breaking. And of course, because we have a big political event coming up in the United States of America in the fall, I don't think anybody really wants to be aggressively raising interest rates in the face of that. So put it all together. Hopefully today's presentation, I think, is given a pretty good anecdotal argument of where we are in the economic cycle. And this should be a tool you guys should be able to use for the rest of your days. Okay, that is basically about an hour and 50 minutes. So I think we had a good conversation here today. We walked through how to build that first 2-week study. I think on the easiest and probably a really good exercise for everybody is to go and recreate this stockcharts.com study and be able to have this in your tool belt and talk about where we are in the economic cycle and where you believe the fund managers believe we are in that cycle. I think, I look forward to the group tutorial that we have, and hopefully we'll disseminate that video in the Telegram group, for example, so everybody can see that. If you have any questions about how we built this and how you can use this in your trading plan, feel free to jot them down and maybe just pass along the question to the group tutorial people. I think we'll leave it at that for today, unless there is some questions here at the end. What do you got here? Warwick says, and Warwick, I was giving a big shout out to you, I think, before you got here, man. Yeah, we were talking about your beautiful call in the crude oil. I was just and my only response is, as a guy I know would say, brilliant. But damn, that was fucking sick, man. Watching the market just melt down right off of your level there. It was so cool. So hats off to you. And it just shows that you guys are getting this, man. I mean, the cool part about it, between whether it's you and this harmonic, or whether it's Ian and his kick-ass fucking day trading setups, or whether it's Kevin and his Kavarkinators, whether it's James and his Jesse James setup. I don't know whether James does his Jesse James setup anymore. But anyway, my ultimate goal is to get you guys better traders than me, and for you guys to actually show me up and show me cool little nifty tools and tricks and stuff that you've learned along the way. if I can get you guys to the point where, like Warwick shows me that harmonic that he's been following and what happened after it. What do you think, Warwick? Do you now subconsciously believe in harmonic levels now? Maybe a little bit more than you did before? I mean, that's the shit, right? Now Warwick, his subconscious is not even going to debate this. He's going to be like, fuck it, remember that crude oil. Jesus. Yeah. So hats off to you, dude. Okay, so I think we'll leave it at that for today. Were there any other questions? Let's see. Crude. Yeah. YouTube link. Okay. Where's that? Okay. There you go, Slick. Boom. Merry Christmas. Okay, I think we'll leave it at that for today. I hope you guys enjoyed the presentation. Can't wait for the group tutorials. I always have fun introducing this week's topic. I hope I did a good job in walking you through this. Extremely powerful tool. And also, it gives you, the ability to go far above and beyond the public's understanding of how economies work, why certain things happen at certain times in the economic cycle. And again, just making that tool belt of yours just absolutely robust. And of course, this is historically, this is a very, very popular way of investing that you just don't hear people talk about anymore, which I'm a bit surprised. So have some fun digging into sector rotation theory on your own. And I look forward to those group tutorials. Geez, that's a good question, Mark. Probably a talk. I don't know where that would fit in here. If theoretically we're still at the beginning of the cycle, then theoretically we still got a little bit more to go. That's about the best answer I can give you, Mark. All right, guys, you have yourselves a great day. All the best, and bye.